Facebook makes sense. I mean, I think Facebook's a stock we've done well with this year in terms of levels and stuff. We said textbook back over the summer in terms of its retracement levels. Chris mentioned the chart levels. Now we're seeing levels we last saw in July of 2018. Certainly appears as though we're breaking out to the upside. You probably own it in the earnings at the end of the month. I would say this, though. Again, I don't think there's anything wrong with taking profits into that number. We have seen tremendous drawdown, is the name, over the years. The last couple quarters have been unbelievably good to the upside. But you know what? I think now you're playing with house money. I would take a little off the table.
Chris brought up three really interesting names because they're rarely together in the same group, other than when a great chartist says it's time. So in the case of BABA, the fundamentals there to me make the most sense. I mean, you really have a case where on a PEG ratio, so price to earnings growth, this is a company that's trading certainly sub one. It's arguably 25, 26 times. There's a lot of catalysts to the name, which also include that they may be spinning off their Alipay. They may be spinning off certain parts of their financial empire. But really, look, their core e-commerce business is growing, and that's exciting. Also, that IPO locally means there's a lot of liquidity in the name. On the other side of the world, it's not a surprise the stock's up 15% since that secondary.
You know what's really interesting about all three of these names, Brian, is they've all weathered really bad macro stories. Facebook, antitrust.
Maybe not to the level of GE, Chris.
GE, the business is dead, right?
70%.
BABA, China. So I like stocks that don't go down on bad news, and I think all three of them start to exhibit those characters over the last year or so, and that's a compelling reason to own these things into what we think is a better macro year.
Facebook's really interesting because you just said it's just come out the other end of something, and I'm not so certain about that. I just kind of feel like this is going to be like the poster child for ESG investing going forward. We know that it's a huge part of a lot of major indices, that sort of thing. So I think that there's a pendulum that has shifted with Facebook, and let's just be clear here. 2019 was a year where earnings did not grow materially for the first time ever in their history because of all the things that they're trying to get out in front of. Sales, though, are downshifting a bit, at least growth-wise. It's going to be a 20% grower, I think, for the next few years. That's the guess. But at some point, if advertisers do leave, if user growth decelerates, if engagement decelerates, and then sales growth decelerates, this stock at 26 times is going to look expensive, especially when you consider regulatory headwinds and some of the other things that might be just mechanical to the way ETFs and funds are created going forward.